Hi everyone, my name is Zui and I'm the consumer analyst at Dragon Capital. Today I'll be sharing a bit of the insights on the ground of the things that we are seeing with the Vietnamese consumer these days, whether the global oil shocks and the geopolitical uncertainties of the first half is impacting any of the growth story that we are seeing for the consumers. Um, First, let's start a bit with the bigger picture of consumer this year. You already saw this slide when Ms. Mai talked about during the overview. I think in the first half, there was plenty to worry about. Fuel prices, the Middle East war, declining savings. But the story is that the consumer is holding up very well. On the left side, nominal retail sales grew 13% in the first half, which is the strongest since 2019. But if we take out the impact of price, consumption is actually quite stable, even picking up a little bit in June and settle around 7%, which is consistent with the track that we have been seeing in the past few years. Well, 7% sounds good, right? But hold that number because the next chart of the revenue of the companies that we are tracking does not look like it. Actually, if this is the chart of the listed official retailers, Mobile War, FRT, DigiWorld, P&J, we strip out the trading part, WinCommerce under Masad. Actually, the revenue was flat for the last 6 quarters or so, around 65 to 68 trillion per quarter. Even if the year-on-year growth that you see here is around 15%, but basically it was flat with a bit of increases. But then from Q3 2025, growth inflects 11% quarter on quarter, and then another 10% in Q4, and then another 7% in Q1. That is, the total number is now almost 90 trillion, up roughly 30% year on year. So consumption is growing 7%, right? But official retailers are growing 30%. I don't think that is the pie growing. That is a big share shift that is going underneath between the general trade channel moving to a more modern trade channel. So what changed in the mid 2025 that caused this significant escalation of sales growth? The answer is regulation. Two forces hit the informal sector at once, timed exactly with that inflection. First is tax. Small businesses in Vietnam used to operate under lump sum tax that is now completely gone and replaced with a proper declare tax on actual revenue. E-invoicing is now mandatory for all businesses with over 1 billion dong revenue per year. So mom and pops now need to start operate under a corporate grade level of transparency. And the squeeze also reached the online channel. From 2025, platforms withheld seller tax at source. The number of active online shops also fell 7% year on year on most of the major e-commerce channel. On the other hand, recently there was also a fight against counterfeits. In May this year, the PM ordered a nationwide crackdown. Tens of thousands of cases, thousands of e-commerce stores shut within weeks because they could not prove the source and the legitimacy of the products that was going in. So the gray market price advantage, untaxed, uninvoiced, is being dismantled by policy at both the online and offline channel alike. So the room for retailer growth is still very large, and we're still very early in this process. If you look at the chart here, traditional trade is still 66% of the overall retail, and on the right side is 86% of grocery retail, one of the lowest modern trade penetrations in the region if you compare to other countries. When regulation raises the cost of informality, right, the decades of channel migration will compress into just a few years. And within the official retailers that we showed you a bit before about, one name really stands out. That is Mobile World Group with the ticker MWG. MWG is converting the trend best in the sector. Revenue in Q1 grew 30% year over year, and the trend is one of acceleration every quarter. But if you look below the bottom line, EBIT is behaving exactly the same. Net profit is up 80% in Q1. Profit growing 3 times as fast as revenue is because the network was already built. So now the incremental sales coming from the traditional channel over to retail drops straight through the bottom line at a very high margins. Revenue is strong not only in Q1, but also in the entire first half of this year, which include the Q2 that we were worried about in terms of the impact of the major macro volatility happening around the world. Within Mobile War, we typically look at two channels, Điện Máy Xanh, which is the ICTC retailer, and Bách Hóa Xanh BHX, which is the grocery retailer. both of the engines are up very strongly. Yet Maiseng is up around 32% year on year. And if you decompose the 32%, half is contributed by price and half is contributed by volume. The price part has two drivers. It's not just purely about inflation. There is some part about inflation being driven by RAM prices that is going up everywhere across the world, which is a bit external and cyclical. But the area that I want to focus the attention about is also a richer mix of more premium products, which show that consumers are moving from the old informal channel to a more modern channel with proper products, good quality, and this is strategic, this is stable, and this will continue for the upcoming quarters. On the other side, on the grocery side, BHX is up 24%. This is almost entirely driven by volume. Exactly what you want from a chain that is rolling out aggressively in terms of store network, more baskets, more visit, not inflation that is doing the work here. But I will also, in a few slides, I will also talk about why the price effect is one of the key driver that is helping Bách Hóa Xanh gaining share versus the traditional markets. This is a slide on breaking down of the Điện Máy Xanh revenue drivers. On the left side, this is the breadth of the products. Almost every single category is up about 20%. Apple is up 50%, AC 60%. So not a single hero product here that is driving this 30+% revenue growth. The whole store is working. On the right side, they are also quite active in building out new categories. Some of these categories are the categories that the informal and online channels used to dominate. So for example, rice cookers, right? Went from 1.2 million units last year to 1.8 million units. So this year, in a 3 to 3.5 million unit market, massive market share gain. Fans, doubled to 2.9 million. CCTV cameras used to be a pilot that was tiny last year, is now 1.6 million in terms of units sold. The point here is execution, right? Điện Máy Xanh is finding new markets to expand into and win shares fast. And it is the same capability that allowed them to gain the leadership position in phones and CE, and now apply across many different other categories. And that execution ability actually travels. Regionally, Điện Máy Xanh has been working on a chain called Era Blue. It's a JV with an Indonesian partner based in Indonesia. Mobile World owns 45%, and this is basically the Điện Máy Xanh playbook being applied abroad and applied at a very successful scale. 5 years in, they have gained 10% of the market share. The stores in Indonesia are twice the productivity of the stores in Vietnam and profitable since last year. One of the very, very few Vietnamese businesses that were able to expand overseas and make it work. With Indonesia looking like Vietnam 15 years ago, if you look at the chart here, 80% traditional trade, 4 times the density of population. This is a big upside that the market has not been looking at. We're looking at another version of Điện Máy Xanh being replicated in Indonesia with much larger runway. Now, to another key asset, BHX, which is the grocery chain. Growth here is driven by a very profitable store expansion. Bách Hóa Xanh was frozen at around 1.7 thousand stores to 2024 when the model was being fixed. But now they're adding almost 200 stores plus a quarter. That is roughly 3 stores per day. A pace that is almost unheard of in terms of the scaling speed anywhere else. They are targeting almost, they will reach around 3,200 at the end of June, and we'll target another 500 towards the year end. And the map that we show here shows the strategies. The old base, which is the color blue, was in the south. 2025 was the year that they started to move into the central area, which is the red, and the green into 2026. So the stores going north, a market that BHX has never touched. And this is also the market where traditional trades were very strong, but are being actively shut down by the government. The title says here profitable, and let me show you a bit of the evidence. In 2025, right, if we break up the new stores into 2 cohorts, 2025, it took them 2 quarters to reach store level EBIT break even, and 3 to cover the logistics at the headquarter level. But in 2026, the new stores that are being opened are EBIT positive at store level immediately. This is covering almost 80 to 100% stores within the first quarter. And in the second quarter, they are already starting to cover the logistics costs, which means that the stores are profitable now, only a few months after their opening. So each vintage, each store cohort beats the last. This is why 250 stores per quarter create value, create profit, and not just the revenue number. In terms of, we usually track the monthly revenue of BHX. If you look at the trend here on the left, monthly revenue step up sharply in Q2 from around 4.3 to 4.4 trillion a month to almost over 5 trillion in June. There's two structural drivers. One is that the northern wet markets closures. When they're moving into Hanoi, Hanoi has created a new dated roadmap to clear over 200 informal wet market sites by 2027, just as BHX arrives. Food inflations actually work in favor, which was a big problem that was partially caused by the impact of the war earlier this year. Wet markets, pass the price increases immediately through, but BHX scales and private label and their own internal sourcings allow them to hold price stable, converting more and more users to their stores. This allowed them to scale the profitability very quickly along with the stores, from 11 billion of PBT in Q1 2025 to over almost 400 billion in Q1 2026. And we're still forecasting that each quarter the profit will be better than the last, and they will reach roughly 2.1 trillion profit this year, almost a 3x versus last year. This is not just a cost cut, this is a compounding of cohorts maturing, plus a lot of the traffic and regulatory tailwind. So the fundamentals are excellent. The share price, sadly, is a bit of a different story. Trailing earnings, right? If you look at the left, the green line is stepping up higher and higher, while the stock has fallen from the low 19s to the high 17Ks per share now. So in dollars term, Mobile beat the index very handily last year, but this year it is down almost 70% versus the index, despite one of the strongest fundamentals that we talk about so far in years. We think this is, being driven by flow, driven by sentiment, and not fundamentals, and that is the opportunity that VEF and DC intends to target. At the current valuation, if you take a simple sum of the parts, with the market cap roughly around 112 trillion, the DMX stake, which was priced by the market in the recent IPO, is worth about 87 trillion. So that leaves only 25 trillion, which is roughly $1 billion for BHX. BHX did a private round in 2024, and back then the company was already valued at 1.5 trillion. So the market price BHX almost 30% lower versus 2024 when it was barely break even, but now it is heading for over 2 trillion of annual profit. I think that is a big mispricing. In terms of trailing PE, trailing PE has come down to almost 12 times, but if you look at forward PE for this year, we're looking at around 11 times PE. This is, if you compare it to the historical past, this is approaching the level that was recorded in the 2022 crisis. Back then, Bách Hóa Xanh was unprofitable. There was a big CE supply and profit issues. But this year, all the engines are firing. We have a new chain that is growing very, very strong in Indonesia. With earnings growing almost 40 to 50% this year, the PEG is extremely cheap as well.